if you're an entrepreneur, should you be betting everything you've got on one big payday? And the answer may change how you as a business owner want to operate your business. So I was listening to a podcast. It's called Money Wise, giving them credit here. And of all businesses that are created, only 0.02% achieve a meaningful liquidity event. So It's crazy. And I'll break that number, because in 2024, there were 5.2 million businesses that were created. And we got a chart that we're going to throw up here that shows business creation in the United States. You'll see a nice big spike from 2020, 21, and it's really kind of maintained a lot higher. So the American entrepreneurial spirit is back and alive after COVID. But if there are about 5 million businesses that are created per year, and then based off of the Census Bureau data, there was about 14,000 M&A deals in 2024. So that being the numerator, the denominator being all those businesses, that means only about 0.02% of businesses potentially have kind of a liquidity event there. So it is a very small probability of having that big payoff. So then the question begs is, should you as a business owner be optimizing and putting all your eggs in the basket to have this liquidity event? Or should we be harvesting along the way or optimizing for cash flow or some combination of the three?
Yeah, it's interesting. I bet if we looked at a survey of the percentage of entrepreneurs that actually think they're going to have a successful exit, a meaningful exit, I bet it's a lot higher than 1%. It's probably half. I bet it's a huge percentage, because I know we deal with more elite entrepreneurs with bigger companies, but I think if we talk to our clients, probably 80 or 90% of them are expecting a meaningful exit. And that could be true, but it might not be true. Yep. It's like they say, right? You need to plan for all contingencies.
Yep, exactly. And then we've got a chart here we'll put up here that just shows the survival rate, which just says in year 1, about 80% of businesses that are created survive or are still around. But by the time you get to year 10, only about 30% of businesses that have been created are still around. So that being said, there's really three.
By the way, we're in year 27.
We're in year 27.
That's pretty good.
Yes.
We broke through that.
Only 15 to 20%, according to this data, go beyond 20 years. So then another visual that we'll put up here is 3 different paths. So as an entrepreneur, as a business owner, I think it's good to be intentional about what is my plan to unlock, if I'm going to unlock the enterprise value or the value of the business that's sitting underneath me. And I think that's important to be intentional, because there's one path, which is, hey, I'm just going to, let's say on one extreme, reinvest all of my proceeds, hyper grow, and just build this thing to sell. The pro being that if I have that big liquidity event, then I'm going to have an awesome personal financial transaction, but there's a lot of risk if I'm not harvesting along the way. The opposite end of the spectrum, which you'll see in the visual here, is going to be the cash flow machine. This is going to be someone who's just optimizing their business and all of their decisions for just cash flow. Really, this would be more like a lifestyle business that's really built around you as the operator. And then the middle ground we'll call harvest along the way. This is someone who's intentionally reinvesting, actively looking to grow the enterprise value, but is also taking some excess chips or excess profit off the table and building meaningful wealth and treasure, so to speak, on their personal balance sheet. So 3 different and distinct paths here. So before we break these down, Jim, which of these 3 paths, if you're talking to an entrepreneur, do you think is the path?
Obviously, it depends on the entrepreneur, but I would say the path that I would recommend for most entrepreneurs is path B, harvest along the way. So even if you're growing a great business, even if your goal is to exit, harvest along the way. Because if it doesn't work out, if it doesn't happen, you have something to fall back on. And I know you and I have seen entrepreneurs that we have coached to do that had enough in reserve to where a business took a wrong turn and failed, and they were able to support their family and start a new business that then paid off. Because often entrepreneurs that don't make it in the first business. Sometimes it's the second or third. But if you don't have any resources, you end up taking a job somewhere and then your game is over. So I like path B for most entrepreneurs. I would say a smaller number would be the build to sell, where you don't even care about profits. It used to be a couple of years ago, there were more M&A deals where there were multiples of revenue in certain industries. And now we're back to more, they want to see profits. I mean, with some exceptions, but usually they want to see profits. So profits allow you to do things. It allows your company to continue. And by taking that profit and investing that outside of the business, you create a war chest for your future. And eventually you have enough money where the business can fail and you're still fine.
Yep. I agree. I think that path B is kind of a healthy middle ground, but I think it really depends on the risk tolerance and then, like you said, the season of life or the phase that the entrepreneur is in. Because I do see quite a few entrepreneurs who maybe have harvested enough off of previous businesses or had a full cycle liquidity event. If they start a new business, they may be focused on that first path of just, hey, I'm taken care of. Let me just see what I can build if I just went all in on trying to build an amazing business and have like that liquidity event.
I love that. I love like they've already become financially secure. They don't need any more money. And now they're like, hey, let's blow this thing up and see if we can create a huge exit. I really like that because then they're okay either way.
Yep. All right. Well, let's break these down a little bit more in depth. So the first path is build to sell. So here, really, it's going to be all about maximizing the business value. Every dollar redeployed, invested back in there, and personal liquidity is really only going to kind of come at a sale. So here, one of the pros is that this is the best way of getting wealthy. And, you're going to make most likely way more money at the sale of your business because you're selling at a multiple of your annual profits than just through harvesting, the after-tax income every single year. And it's just like, that's I think, truth. Now, there's also the most risk here. You're going to have the concentration risk here. You're going to have the fact that only 0.02% of businesses based off of this data actually sell. And then it sometimes takes a long time to have that liquidity event. So are you going to be able to stay in the game? If you're not harvesting and building your wealth and you're not having those dopamine hits or that gratification along the way, sometimes it's hard to stay glued in if you're not getting the positive reinforcement of seeing your balance sheet or your net worth grow. But from oftentimes we'll see this really in Silicon Valley, venture backed, right? They're looking for 20% plus internal rate of returns as investors. And so oftentimes, really Silicon Valley, this is the playbook. And I think that's the easiest analogy of like the build and optimize for sale.
Yeah. I was just talking to someone the other day who had fallen into the build to sell, and it was in the space of VR. And if you think about it, there was this time where Apple and Google, they were buying up VR companies for huge multiples to get the technology and everything else. And so they felt like they were on the cutting edge. Things changed pretty soon. They were no longer the leading technology in that space. And their company went from what they thought was a lot of money to worth nothing almost overnight. And that can happen when you're trying to build to sell. On the other hand, you can get very rich. There are some people that got very rich over this concentration. I'd say you got to know what you're doing, and you also have to not only do the smart things, but also plan for the exit. And I think things like a C Corp, if you want to get the 1202 treatment that was increased under the One Big Beautiful Bill, that can be great. If you plan to take on investors, you want to really think in that A level of what does the exit look like and how to prepare for it today. Are you going to try to go public? Are you going to take on investors? What's the right structure for all those outcomes? And that has to be paramount if you're not thinking about harvesting or cash flowing.
Yep. And just to break down that 1202 concept, if you are a C corporation and you hold your C Corp stock for 5 years, at the sale, you get $15 million or 10 times your investment or your basis tax-free. And then you can stack this with different irrevocable trusts. If you hold it for 4 years, you get 75% of that tax-free. Hold it for 3 years, 50% of that tax-free. So just putting some frameworks around that. And to your point, we oftentimes recommend and see a lot of our clients who either have side businesses or are building a business intentionally for that liquidity event structured as a C corporation because of those favorable tax treatments under Section 1202.
Yeah, that makes sense, because if you were building to take money out of the business, a C Corp's probably not your number one option because of the double taxation. You get taxed at the C level and then you get taxed at the personal level. So there may be a better entity structure if you're looking to pull money out of the business over time.
Yep. Awesome. So let's go through option B. This is going to be kind of a middle ground here of harvesting along the way. You and I both are biased towards this. This is what we're actively doing within our business.
Yep.
And so the idea is that we first are going to feed the business because that is the golden goose that is laying the eggs. So you need to first make sure you're redeploying enough capital back into the business where you hopefully are getting the highest rate of return compared to anything else that's available to you from an investment perspective. But then as there's excess free cash flow or profits, you're taking that, you're distributing it, and you're building up your personal balance sheet. So that way you're socking away some squirrels or some nuts, I should say, like a squirrel for winter there. So this helps with diversification along the way. But the idea, or that one of the downsides here, is that if you could have hypothetically grown the enterprise value even faster by redeploying more capital here, maybe you're not going to sell at the same multiple or the same exit price as if you went all in on just optimizing for the sale. So there's some pros and cons there. And also from a tax perspective, a little less tax efficient, because if you're taking profits out, generally depending on your structure, if it's passed through, you're paying ordinary income and they're going to reinvest those after-tax proceeds. Whereas if you're redeploying all of the cash in your C corporation, you're only paying 21% on your profits before you redeploy it back in the business.
Very true. Yeah. As you said, I'm biased toward that just because anything could happen before an exit. And if that's what you're hoping for and that's what you're betting your entire financial future on, that can be a problem. But yeah, I like to pull money out as you go along.
Yep. All right. Then the last one would just be optimizing for cash flow. This would be more of the traditional lifestyle business. Think of a high producing attorney or consultant that maybe has some support staff that help optimize or fine tune the professional or the service or whatever it is. But there's really no enterprise value there, right? There's nothing transferable. There's no way to have a liquidity event because it's more of you've got a glorified job, which is a business, and then the system, the team, and the infrastructure is just to support you, and a buyer's not going to want to buy a job. So this is really optimized for a lifestyle. And generally here, the definition of success is probably how much are you making per hour worked, because you care about not only the numerator, which is how much you're making, but also the denominator. How much time are you working? Because that's where I think how you would define success here.
I remember there was a guy that I knew in town who was a financial advisor, and he had built up a book of business of just mutual funds with trails. So this is probably 20 years ago. And there were people who wanted to buy his business, but the more he looked at it, the more he figured out, you know what, why don't I just create a lifestyle business out of this business? And what he did was he fired all his staff. He went to all of his clients and he said, hey, if you want to move your money away, and they were all in mutual funds and paying him 0.25% trail every year. And he said, well, if you want to leave, you can leave, do whatever you want, but I don't have any staff. So when you need me, it's going to take a few more days to get any paperwork done. I take 2 weeks off a month and go to San Diego. So I'm only working 2 weeks a month, and we can meet at the coffee shop, or you can come to my house, or I can come to your house, but I don't have an office. And so some clients left, but a lot of clients stayed. And what he told me was he's only working 2 weeks a month, and he was making more money than when he was running his business. So that's kind of the lifestyle business we're talking about. He just cut it all down, made it unsellable, but didn't care. And he was probably about 65 or 70. I don't know how long he did that, but he could have done that for another 10 or 15 years and really enjoyed it. So that's a lifestyle business. That's what we're talking about, something like that.
I think the biggest thing here is being intentional, because he was very intentional. So that is a very clear definition of success. Whereas I think oftentimes entrepreneurs are not intentional. They're just kind of inertia. It's just taking them in a certain direction and they don't really know. And I think that's the biggest thing here is take a second to zoom out and be intentional about what the exit plan is going to look like, or what type of business are you trying to build, and then optimize around that instead of letting just life drive you down a certain, trail that maybe you don't want to go down.
That's very true. And entrepreneurs often are running a business without thinking about doing the basics like books and records, because sometimes entrepreneurs are running businesses, making a lot of money. They're not thinking of selling, and then all of a sudden someone comes forward and says, hey, private equity steps up and says, hey, we'd like to buy your business. Let's have a conversation. And then they get down the path and PE beats them up for having terrible books and records, because they thought, well, I never thought I was going to sell this business. So you should always be preparing like you are going to sell your business, even if you're thinking of more of a siphoning money off over time, or even a lifestyle business. Someone always might want to buy your business. So you should be running the books and records, the P&Ls, as if you're going to, and that'll help you run a better business anyway, even if it's a lifestyle cash flow business.